Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. Investors weren't particularly thrilled with JP Morgan Chase's latest earnings report. While the company beat revenue and earnings expectations, the CFO lowered guidance on headwinds such as wage inflation and moderating Wall Street revenue. We see this as a temporary setback for a company that's poised to deliver serious returns to shareholders. And despite the negative momentum, JP Morgan is an incredible value. And with interest rates set to rise, bearish sentiment seems overdone. JP Morgan needs little introduction. The Mammoth Bank, led by CEO Jamie Dimon, manages $3.74 trillion in assets, with stockholders' equity worth $294.1 billion and operations in more than 60 countries. But it's pretty tough to analyze JP Morgan and not start immediately talking about the financials. That's because we analyze banks differently than other businesses. As such, we wanted to use the 10-year history to highlight the sizable revenue and dividend growth, as well as the book value per share. Now, we judge most banks by their non-interest expenses as to whether they manage themselves well operationally. Management has highlighted higher expenses, with a large chunk driven by incentive compensation. This has been a key theme across multiple banks. Consequently, JPM expects non-interest expenses to increase by 8% in the coming year. However, part of that comes from investments in technology. The good news is that they also see growth in net interest income driven by higher rates of $2.5 billion in 2022, with an additional $4 billion from loan growth. This helps offset the costs and a drop in investment banking revenues, which have begun to wane as the Fed pulls back on stimulus and general trading declines. Now, to get a sense of JP Morgan's value, we're going to stack it up against other banks that reported during the same period. Citigroup is the cheapest bank, looking both backwards and forwards according to the price-to-earnings ratios. However, JP Morgan doesn't look too bad and holds its own relative to its peers. Price to book is the only relevant metric where it comes out more expensive than its peers. Wells Fargo had the best year-over-year revenue growth. But looking forward, JP Morgan is set to outperform its peers. Additionally, JP Morgan smokes them all when it comes to consistent revenue, income, and earnings growth over a multi-year period. Lastly, we want to note that JP Morgan has the best net income margin, return on equity, and return on assets. In our opinion, this is an 8 out of 10 stock. We love JP Morgan and wouldn't be ashamed if we owned it here at $150. However, we expect earnings to continue to weigh on stocks for a few more weeks, hopefully giving us a chance at $140 per share. Click and subscribe to the Spill newsletter to get the full breakdown.